Hello everyone. As your host for this conference, I would like to welcome you all. Just to give you a little context, the genesis for this event is actually a simple WhatsApp conversation between Aso Shanglai, who is the founder of C-Marketplace, and Ganesh Rengaswamy, founder Quona Capital. It was felt that IMCAL entrepreneurs will be better off with some structured discussion around what it takes to get superior outcomes for startups. So, given that equity funding is an important growth driver for startups, and hence today's conference revolves primarily around this aspect. Initially, this conference was envisaged as a much more closed door discussion involving only IIM Calcutta alumni, but eventually it was decided to open it for all to widen the benefits. I welcome non IIMC alumni and IIMC alumni to this conference, and I want to thank you all for taking your time to attend this. So Asos Shanglai, founder C-Marketplace, and Sandeep Devrapalli, founder Hackstrap, are the organizers of this conference. I would like to thank both of them for all their hard work, including the team who has supported, their respective colleagues. I would like to thank them as well. The first event as part of this conference, there are two events. The first event is a talk by Ganesh Rengaswamy on the topic VC entrepreneur startup relationship demystified. Before I request Ganesh to take over, I would like to introduce him to everyone. Ganesh is co-founder Quona Capital. Quona is the first emerging markets only fintech VC firm. Quona Capital backs innovators who enhance the quality and availability of financial products and services for underserved consumers and enterprises. Ganesh is also recognized among top 100 people in fintech for Asia. He sits on the board of multiple companies, mostly fintech companies like Zest Money, Neo Growth, Fisdom, SME Corner, Credit Mantri, and India Mart, among others. After graduating from IIM Cal, he worked with Infosys for a few years before joining Harvard for his higher studies. He then founded Travel Guru, a travel tech company that got acquired by Travelocity. After exiting from Travel Guru, he worked with VC funds including Greylock Partners, Unitas, Loeb Capital, Axion, and now Quona, which is also backed by Axion. So over to you, Ganesh.
Sorry guys, I was on mute. Thanks, Samir. Yeah, I was just hoping that this intro doesn't go on for too long because it's very embarrassing to see the intro read out about yourselves. But thank you so much for the kind introduction. And yeah, I have done sessions within investor and entrepreneurial forums so many times, especially now with Corona. This has become the way of life. But I'm probably more nervous today than usual because the discussion, like as Aso and I discussed, it's a nuanced topic when we talk about the relationship between investors, founders in the context of a startup, and it's definitely very hard to do justice in a virtual format. I like this, and but the bad news, for all of you is I've been told there is no Q&A in this 20-30 minute session. So this is going to be a one-way monologue, unfortunately, which is another thing which makes me quite nervous, and I just hate it because there is no way to know whether anything that I'm saying actually is making an impact. But let's go with this. Hopefully, at least actually, why don't I do this? So can I share my screen? Oh, yeah, it's working. So let me share my screen. I'll probably use a couple of slides as reference point to make sure I stay on course with time. Okay. Can you guys see my screen?
Yeah, we can see your screen.
Okay, perfect. So maybe I'll literally take 10 minutes to set the context. I think Samir, thank you for the introduction. I think you have already done that very gracefully. I'll just maybe give a couple of minutes on that so that there is context when we start talking about some of the aspects that we want to cover. Very quickly on Quona, as Samir said, we are one of the most active fintech investors globally, and at least in emerging market, we are now the largest VC. We've been around as a firm for 6 years, but number of us, common ideologies around financial services, digitization of financial services, and particularly the difference that can make to emerging markets and underserved and unserved markets was the theme around which we came together. The three of us were founders of Quona from sort of pretty much three different parts of the world. Common thing about us is all of us have been entrepreneurs and have uh, had a venture and entrepreneurial careers in Silicon, and then done extensive work in our respective markets between Asia, Africa, and Latin America. Um, uh, Quickly, I think we have talked about my background, and I'll move on. The only point I'll make here is that as context, I'd like to uh, share the fact that Kona is very much an entrepreneurial journey for us. And frankly, I became VC after Travel Guru. Now, when we started Travel Guru back in 2004-5, the venture or investing ecosystem was very relatively in India, as you can imagine, 15, 16 years ago. Uh, and even some of the best funds and investors who were sort of exploring India at that point in time, and some investors who today are arguably amongst the best known angel investors in the country, we had some of the most ridiculous discussions in terms of how to think of equity valuation. People telling us that when we walk in by the end of a 30-minute meeting, telling us, okay, you know what, you guys need a CEO, go find somebody, then come and talk to me. Then we heard all kinds of stuff. So I think obviously 15 years younger, and some things stick with you, some things are even borderline insulting or humiliating. But as you evolve and mature, I think it's more important to look at those and take the lessons from that. And frankly, the one of the biggest reasons I became an investor was that I realized there was very little understanding of entrepreneurs on the investment, and that's also because in those days a lot of the investors came from a very professional either banking or private equity investing background, and so a big part of my evolution was really to be an investor by being able to relate with entrepreneurs and have that meaningful empathy. And Kona, of course, is started from scratch. We were initially supported by in the first 6 to 9 months of our journey. Post that, Quona has really evolved into a fund of its own, and we have a large group of stakeholders across sovereign wealth funds across the world and several Fortune 100 financial services. And we continue to have the relationship with Axion. But the point here is it's as much an entrepreneurial journey for us as for any other entrepreneur in this group, just that it happens to be a venture of different nature. And, and as I tell people sometimes jokingly, fundraising for a fund, and I hope I wish no one in this group has to go through that, but fundraising for a fund can be a lot more brutal because we just go to folks and say, hey, we'll find fantastic entrepreneurs like some of the folks in this group. Just trust us and give us the money. And you can it might be hard to imagine, but we have got a weird look more than I would say more than a couple of times. So in that sense, fundraising for a blind pool or a fund is lot more challenging, frankly, than an operating startup. Because when I raised capital at Travel Guru, at least I knew what I was doing, and we are betting on ourselves, whether people believed in that or not. At least they knew who they were betting on and what's the business. Uh, but moving on from here again, I will skip this for now. The only point we made here is most of the companies in the center and right of center are companies in Asia, and I kind of focus on Asia, and my team focus on Asia for Quona. So we have a fairly sizable portfolio between India, Indonesia, Singapore, Thailand, Philippines, etc. So moving on, I think I'll just use these two slides as reference points for the discussion. So I've done this usually this is an hour and a half discussion which I've done in focus group with entrepreneurs. So it's very challenging to do it in this format. But let me try my best, and hopefully there'll be some takeaway for folks. So when we look at the relationship between a startup founder and VCs, I think to encapsulate the complexity or the nuanced relationship and elements it comes with, I just split it into three categories, right? And obviously, founder starter relationship, the VC startup relationship, and the founder VC relationship. And anything highlighted in green is arguably the primary role of that particular participant. In the first column, it's the role of founder. In the second column, it's the VC. In the third point, responsibility. Anything in yellow is a shared responsibility with other stakeholders, and anything in red, I think, is what one should be concerned about, and we can talk about that probably more. And this is by no means an exhaustive list, and frankly, this is trying to take a very nuanced topic and add some perspective to it in a group setting like this. So if we look at the first column, I mean, a lot of you are experiencing this and going through this. Of course, you are the primary cheerleader of your startup. The buck stops with you. You have the bottom line responsibility. I think if you look at the owner column, the reason why I put ownership is because one is you are an owner, you have a sense of ownership, but also it evolves as you bring in other stakeholders into the organization. So when an entrepreneur starts a journey, they could have 100% ownership, but or whatever majority ownership. But as other partners come in or stakeholders come in, the percentage ownership might change, but you still are pretty much you have to have the sense of ownership in the organization. The couple of the other green things are very obvious, and being an evangelist and one of the key stakeholders, those are very obvious. The last two, what I'll point out is, if you look at the insecure leader, I think we have seen situations where some founders, and usually it could be a single founder or it could be two or three or four or five founders, but if there is a dynamic where a founder or a co-founder has got into the role with a passion to be an entrepreneur, but is unclear, especially in a multi-founder company. Sometimes, as companies evolve, the founders don't scale, and some founders are unsure or uncomfortable with their the respect and authority they have in the organization. And when I say authority, it's moral authority. I mean, in a startup, really nobody has authority over anybody else. And that could create challenging dynamics. Like there are companies where we have had a very tough time hiring head of products, or a very tough time hiring CFO, etc., because a certain founder was doing that role, but as the organization scales, they do realize that they are not scaling up. But of course, they become a limiting. They're not comfortable inviting people in. Founder misalignment is something that could happen between founders. In fact, in some companies, we have seen as basic misalignment as two founders, both great, good friends, but they both wanted to be CEOs, and it was a type of situation where we couldn't make them co-CEOs because the company really needed direction to know who is in which seat in the company, and the external stakeholders and partners as well needed that. And it really became a tense, sort of a passive aggressive tense situation between the founders, which at the end, frankly, led to an exit, because after a point the company could not continue in that. If we look at the column in the middle, the relationship between VC and the startup, I think a lot of the investors, especially the earlier stage investors, I think are expected to set the tone of governance in the company, and help and enable the founders to be able to set that tone. The second and third bullet in the VC startup column is the obligations an investor has towards the company, which when you are sitting on the board, typically you are supposed to be always thinking what's in the best interest of the company, and then the founder and your own fund and all of that. Uh, in reality, it's a lot more complex in terms of how that. And then one thing to remember for entrepreneurs is a lot of the professional investors have their own investor obligations as well. So, there could be sometimes a tension between the obligation of an investor to the company and to their own investors, which is their LPs, right? And those situations sometimes become challenging, and usually the LP obligation aspect is not exposed to the entrepreneurs, which is why sometimes it leads to a subtle tension where the entrepreneurs might wonder why is an investor behaving like this, and that frankly, if that keeps accumulating over time, it can lead to complexities of its own. Then the bullets in yellow probably are self-explanatory, especially on the fundraising side. I would say if your investors are worth you know, worth the credibility they come with, they have to be able to really open doors and open some of the best possible next stage if you're going for fundraising. And even and the right kind of investors can be phenomenal support even on recruiting and business development side. But I'll kind of move on in the interest of time, focus more on the reds. So one of the things I say quite often, and people ask what does it really mean, is the uh, most damaging type of investors I've seen in a board. So these are investors who are who half the time do board meetings virtually times, but even in normal times, I'm sitting in San Fran. I've invested in Indonesia or Singapore. I'm a fly out investor. Well, that's just an example. It could be anybody, frankly. It could be someone local as well, or don't show up in board meetings. They're always checking their phones. Might have done an investment several years ago in the same space, and suddenly they will wake up and say, "Oh, you should talk to that founder whose board I was on," without any context. And then, as an entrepreneur, you feel obligated, or they will give you some right idea without enough context, and you rarely hear from them between board meetings, unless there is some there's some financial challenges in the company. So and people who are not in sync with the business you are in, typically, and lot of and so those I have seen are probably the most challenging folks to deal with, especially if they have a strong voice. uh, and again, we can talk about this more during the day, but that is one I'll really watch out for, which goes to one of the classic points we make on be careful who you bring on board, because for an entrepreneur, fundraising is very important, but bringing the wrong folks in could be a lot more detrimental than not having capital. Trust me, that is true 10 out of 10 times, even though it never seems like that when you're fundraising. And the last one here is just misalignment between, the last two, competing investment is self-explanatory. And, I've also said this in multiple forums, it's become quite common for a number of well-known pedigreed investors nowadays to pick a theme and bet on multiple companies in the theme. Uh, and again, I come at this very much from my hat and mindset, and maybe that's why we never take a gambling approach to it. We back in one company in a space and then go after the company, one company in a space or a certain company in a space in a country and go with it. But there are several space in sectors in India where folks have done this. I mean, in B2B commerce, in some in neo banking or digital banking, there are so I think that could cause challenging situations for entrepreneurs, and they should really ask themselves and the investors. Ideally, that should not be entertained, But if it happens, then you have to have the hard conversation on what does that mean for you as an entrepreneur, because this is probably the only company you're running. I'm sure the investors wouldn't feel excited if you have three different companies and you say, you know what, I will rotate my time between the three. Don't worry about your money. So no, it should not be a one-way street. It goes, the same thing goes both ways. And the last is co-investor misalignment, which sometimes happens. Again, sometimes it happens because of this multiple investments. Sometimes it happens because investors have very different views on where the company should go. Sometimes it happens because one investor came in at a valuation of X, the next one investor came in at a valuation of 4X. Initially, you feel great about it, but trust me, unless everything is fantastic from there onwards, it can make life miserable. And I've been on the receiving end of that, because the investor who came in later is always feeling nervous about the fact that they really paid up, whereas the one who came in earlier is already in the money and not feeling the pressure as much, and the way they operate in that context could be different. Um, Actually, can we go on for another 10 minutes, or what is the cutoff time, Samir?
Ganesh, you can go on. We have ample time.
Okay.
So we intend
So,
to start the panel discussion at 3:45. So you
okay,
can go on till then.
I think we'll wrap up in 10 minutes. If there are any questions, I'm happy to address after that. So the third column is the founder VC1, and frankly, this is everything is defined by this, because end of the day, if you look at all the bullet points on this slide, uh, 80 to 90% of them are basically human dynamics and relationships. They're very nuanced, EQ related stuff. Only a few of them are really objective things. So the founder VC relationship, I think, again, it's very subtle, and that's why it's important to spend a lot of time before you agree to welcome somebody into your home. Again, in the heat of getting a fundraise done, entrepreneurs a lot of times, take the shortcut or get aggressive to get the money. But it's really really important to figure out who are you letting into your home or into your company. Um, so again, the first couple are quite self-explanatory. The devil's advocate point, the third and fourth, what I tell people is, when entrepreneurs are over exuberant, then it's your role as a well-wisher, investor, and shareholder, and a collaborator to play the devil's advocate. And when entrepreneurs are down, it's actually your job to figure out how you can be, a cheerleader. And there is a fine balance in that, but you have to kind of support as the situation demands. It's not, it shouldn't be a unidimensional role always. A relationship between the founder and VC. And there are some situations where obviously, if enough trust and comfort develops, where the investors can be a good coach. Some investors can be good coach to founders, because the founders obviously are very heads down focused on what they do. Some founders have the ability to probably run parallel tracks on long term vision and short medium term execution, but several founders don't. It's not something taken for granted in all founders, and a good investor can be very much a strong mentor or coach. And some founders, especially if you develop even greater degree of comfort, use an investor they are quite comfortable with as a venting ground, and that happens only once you reach a point where you feel you won't get judged for every single challenge or concern that you take to the investor. And if you look at this, probably progressively as you get comfortable or you develop a relationship of trust, you mature into the relationship and the dynamics. The one in yellow is self-explanatory. The last two, I think, again, are not very are I guess self-explanatory. Some investors again, have this, especially folks who one of the things is folks who have not been entrepreneurs or not been a day away from, say, not being able to pay salary or not being able to pay your vendors or losing a big contract or whatever. It's very hard to simulate those situations. So sometimes it's also challenging for investors who have not been in that situation to appreciate it, and they come up with simplistic solutions. And that is again just an example, but this could happen in several context. If the investors don't have a context, they think the solutions are easy and we can just, we have so many ideas. Why are the entrepreneurs not making it happen? So that kind of backseat driving, I think, is dangerous. You want people to challenge you, and if you are not open to being challenged, then I think that's a danger sign for the entrepreneur. You want someone who thinks they have the answers to stuff that you have been struggling with for maybe weeks or months in some cases. And then the last one is of is like usually the more strategic lack of alignment, or sometimes team lack of alignment. I've seen number of cases with some teams where, let's say, there are three founders, where there is a founder who has a very good relationship with two other co-founders, and they are all very a tight unit. But sometimes the investor feels that one of the three is a weak link. So I've seen fundamental lack of alignment there, where investor might feel that the role of that particular person has to change, whereas the primary founder would defend. It's hard to say who is right or wrong without knowing the situations well, but things like that usually significant tension. It's important to kind of watch out for that, and look for early signs in those things. So moving on, I think I'll just go to the last slide and say, the bad news is I don't have an answer to how to solve all this. The good news is, I think all I can tell you is what I have learned from my experience on how, some of the fundamental orientation and the way I have approached things have helped me in the past. The first and foremost, I think, and by the way, a lot of these things very conceptual, or could even be looked at as being quite academic. But frankly, I hope that based on your experiences, each of you will relate to some of them. I have them here because I relate to all of them, and at different points in time, I have learned it. So first one, positive intent. I mean, one of the things you didn't, maybe folks didn't notice. I had written Quona is sort of my entrepreneurial journey 3.0, and I've had actually I tried two other things. One was very brief, and one was actually a startup I was helping start for almost a year, which didn't work for a number of reasons. But those failures also actually learned me probably more, taught me more than what I have learned, at Quona. So the positive intent is a very important thing. I realize it's so easy to start complaining. We can look around and complain about everything, especially in today's world. The second one, which took me a while to learn, is only if I overcome the complaining and really start coming up, get into a frame of mind where you say, okay, what is the problem, and now let's figure out how to hack it. Instead of intellectualizing on why the society or why the construct is like this, or why investors are like this, or why employees don't care as much as we care, or why corporates take so long to sign accounts, etc. I mean, some of these things we have to accept as reality, and then say, okay, how do I hack this, and what are the best examples that I can learn from to hack. Right. The third, which is a very fundamental pillar for us, actually, in a number of our companies, and even for us at Quona, is what we call intellectual honesty in in accepting mistakes and challenges. A lot of times as entrepreneurs, we don't want to accept it, and sometimes we accept too late. But if we don't even acknowledge, for example, the market is too small, but and or some businesses do not need investing because they're in a small market or niche market, but can do very well without the pressure of, let's say, external funding, because you're not looking to build the kind of companies or the outcomes that classical institutional investors would look for. But people come under the pressure because maybe somebody else I know has raised, and so on and so forth. Right. So acknowledging some of this is probably the first step to figuring out. Then, okay, what do we do with it? Right. And then the next one is, I realized, especially in India, anything that is that works or is too good definitely attracts enormous amount of competition, right? And generally, when I have these entrepreneurs, they say we have the best team, or if it's a tech company, they say we have the best team, we have the best tech, we have the best product. Nobody can touch me. Some people are a little bit more open. They say, we have an 18-month lead or something like that. But the general realization I've had is, given how many more tools are available in the world today, I don't think people have the kind of they think they have. They have to constantly keep evolving, and competition comes. And there are a lot of big companies who also come with solutions that work nowadays, because people have the pressure to show performance. Right, and this is true for startups as well. There are a number of startups which don't know what they're doing, who have raised 100, 200, 300 crores today. Right, and if something works in their zone of expertise or the zone they operate in as a company in the space, they will go after it. So this happens a lot, and sometimes we notice it too late. Then the fifth one is the tough part of a founder's job is you always have to be the evangelist and the cheerleader. But there is a little bit of a twist here, where what I have realized is, when the going is tough, or if, for example, there was a big partnership, or an investment that you are going to close, or a senior hire you're going to make, or whatever, which the company knows about and is excited about, and let's say it didn't happen. I think basically I'm trying to say in a roundabout way that bad news, the team can handle bad news. Sometimes that is something we don't recognize. I didn't learn this till very late in my life, that it's probably sometimes important to in a mature way share bad news with the team, and if done the right way, it could also motivate people to perform extraordinarily. But eventually, yeah, all of those things, the good and bad, are is on the founder or the founders. Um, the second last bullet is really around the fact that, again, this is a very delicate balance in today's world, which is becoming more complex because there are more entrepreneurs, there is more access to information, there are more investors, so more companies are generally sort of starting up in similar spaces. So I guess it's important to kind of understand and learn fast, but also at the same time challenge things which are not succeeded. Usually, the way it works is, once we have a hypothesis or narrative in our head, I think we only look for proof points to validate that. We don't look for proof points to negate it. And in the early stages of a company building, I think that learnability is very important, to also push ourselves to figure out why something may not work, and look for examples. Probably, sorry, can you guys hear me? I'm getting a unstable signal message here.
So
Can you
Ganesh,
guys hear me?
yeah, it's sometimes it's little bleak. Otherwise, we are broadly able to follow you.
Okay, okay. Thank you. So the second bit of is that we have to obviously be intelligent around what competition is doing, but but I think the danger in today's world is really run into the FOMO of playing competitions game, and trying to be in step with the positioning or messaging that a competitor is doing, especially if you believe that they're getting a lot of market interest or investor interest. So I think there is again that fine balance between and learnability, which is a hard one, and I think it's a daily process. And the last one, which I still honestly don't have a solution for myself on this, is I really hope for. I mean, it's never too late, but especially for younger entrepreneurs, if you can find an independent mentor or coach, or even in some cases, frankly, therapist, because that's needed in some situations, to kind of engage with, who will get to know you over time, and hence can be more helpful as time goes by. I think it can be a massive, exponentially positive impact. I've seen people for whom this has really worked. I have not been successful at this. I don't actually, frankly, have a sound sort of cornerstone on any of these three dimensions. Maybe a little bit in the coaching dimension, but I highly recommend that. It can make a huge difference in a stressful entrepreneurial journey. So Samir, let me stop there. Again, like I said, it's a monologue and hard to know what's really the message coming across. But let me just stop there. Happy to go
Sure.
wherever we do from here.
Thank you, Ganesh. That was very helpful. So the way we have structured this, Ganesh, actually the Q&A, is not part of this session. However, if Aso or Sandeep, as organizers, if they have received any questions in private, so they can probably ask you some questions. Otherwise, we have not planned for any Q&A. I think you explained it quite well. So that's very helpful. Thank you, Ganesh. So Sandeep, can we move on to the next event, or are there any questions that people in the audience have for Ganesh?
There was just one question. Someone asking about what is an LCM. So, since I was clueless, I had to
I
ask.
think that maybe too fast. It's I say it's the least common multiple. Something we learned obviously long back in math. But basically, in board or entrepreneurial language, I would say it's a board member who is a drag on the company and understands the least and probably has opinion.
Thank you.
Great. So should we take a quick 2-minute break? And I think some of the panelists also want to check their audio. So Aso and Sandeep, if you can enable that. So we'll just take a 2-minute break and then we'll start the next event, which is the panel discussion.
Okay. Sandeep, please take care of it. Yeah.
Yeah, sure.
Hey, this is Gan. Am I audible?
Yeah, you're audible.
Yeah.
Hi, this is Parappa. Am I audible?
Yeah, Pranapa.
Yes, Panapa. It's clear.
Hey guys, hi, it's Pavan this side.
Hi, Pavan. We can hear you.
Hi, Pawan.
Hello.
Hi, this is Pratap here.
Pratap, we can hear you.
I've got a flaky connection at home. There's a power cut, so I'm working out of a dongle. So I hope I'm going to be able to manage this.
I wanted to see you also, Pratap.
Yeah. When I'm speaking, I'll speak. I'll come on. I'm, so right now I'm in the audience myself too, I guess.
Great. So can we get started? Asu and Sandeep, can I go ahead with the next event?
Yes, please start. Please.
Yeah. So the next event is the panel discussion. The topic is issues in fundraising: what, why, and how to solve them. So we have 8 panelists. Beyond me as moderator. So I'll introduce you quickly to each one of them. So for those of you who joined late, just to reiterate, the panelists are all IIM Calcutta alumni. So this was originally meant to be a smaller event, more closed door. Then we decided to open it for everyone to kind of widen the benefits. So, but the panelists are all IIM Calcutta alumni. Although it's not by design, but we have one panelist from the 80s decade of graduation year, and 2 from 90s, and 2 from 2000s, and the maximum number out of the 8 panelists are from 2010, decade of 2010. So that's how the split of the panelists is. So I'll start with I'll start the introductions in the chronological order. So Ponappa is the senior most alum here. So he is a founder of Limitis Non, which is a consulting accelerator that offers mentorship and business advisory services. He started his career with Asian Paints, and he spent around a decade in marketing functions for brick and mortar companies. And he headed marketing for Asian Paints and Black and Decker, I think. He then moved into leadership roles for tech companies, including heading companies like AOL India, M Portal, etc. So as I mentioned, he then started Limitis Non, which is a consulting accelerator that helps startups take key strategic and business decisions in the technology space. So he also has a network of angels and mentors, which is like his private syndicate, who help startups, again, not only with capital, but also help them take right decisions early on in their, life cycle. And they offer deep mentorship and also provide capital, like I mentioned earlier. So he has a very strong understanding of both the brick and mortar and the tech world, and he also has a deep understanding of urban and rural markets in India. So welcome to the panel, Ponapa. Welcome to the panel discussion. So the next, panel member is Pratap. He's co-founder Quicksilver. Quicksilver is the pioneer and the single largest end-to-end service provider in the prepaid gift card space, serving the who's who of the retail and service industries in India, Middle East, Southeast Asia, and more recently in Australia and New Zealand as well. They manage over 700 million transactions annually. So Pratap and his co-founders, they raised multiple rounds of VC money, Series A, B, and C, from venture capital funds like Axel, Helion, Amazon. Amazon also has invested in Quicksilver, and they've also raised money from Systema Asia. And last year, in March 2019, the company got acquired by Pine Labs. This deal took place in March 2019, and the valuation of the company then was over $100 million. So prior to co-founding Quicksilver, Pratap worked with Wipro and a few consumer companies in leadership roles. So the next panelist is Ganesh. Obviously, those of you who joined the conference right at the beginning already know Ganesh because I introduced him. But I saw that there are more than 20 people who joined during the session of Ganesh. So for their benefit, I'll make a quick introduction to Ganesh. Ganesh is co-founder Quona Capital. Quona is the first emerging markets only fintech VC. They back entrepreneurs in the fintech space who enhance the quality and availability of financial products and services. He's recognized among top 100 people in fintech for Asia. He sits on the board of multiple fintech companies. He started a company called Travel Guru, which got acquired by Travelocity, and after that he's worked with a few VC funds before starting Quona. The next panelist, welcome Ganesh and Pratap. Now I'll move to the next panelist, who's Anindita Sampath. She's co-founder of Yoga Bars, the brand, company Sprout Life Food Private Limited. After graduating from IIM Cal, Anindita worked with Cognizant for a few years and then with EY in US, where she was part of business advisory and transaction advisory teams. So Anindita and her sister thought of bringing the concept of energy bars back to India, and that's how Yoga Bars was born, I guess, in 2013. So welcome, Anindita. So the next panelist is Abhishek Sharman. Abhishek has over 15 years of investing experience. So he's founder and managing director at Carpe Diem Capital Partners. So Carpe Diem Capital is an India-focused private equity fund with a focus on small and medium-sized businesses. Their sectors of focus include consumer products and services, healthcare, financial services, managed services, and education. Prior to founding Carpe Diem Capital, Abhishek worked with India Equity Partners and Sun Private Equity. So the next, welcome Abhishek. Next panelist is Pavan Nanda. So he is founder of a gaming company called Winzo. Prior to founding Winzo, his previous entrepreneurial innings was as co-founder of Zostel. So, like I mentioned, Winzo is a gaming company. It's a mobile esports gaming platform that offers monetary benefits to the gamers. and they are backed by multiple VC funds. They raised their Series B recently from Makers Fund, Courtside Ventures, and Kalari Capital. He's also raised his Series A capital from Kalari and Hike. So, welcome, Pawan. The next panelist is Sudhanshu. He is founder and CEO of Add My Brand. So, after graduating from IIM Cal, Sudhanshu worked with Adani Group before starting Add My Brand in 2017. Add My Brand is an analytics driven ad exchange for advertisement on outdoor media, hoardings, mobile radio, TV, and newspaper. It aims to become the virtual assistant to every marketing professional. Welcome, Sudhanshu. The last panelist is Gyan Tiwari. He's currently with Swiggy, heading their new business initiatives. And prior to this, he founded Mficient, which is an enterprise mobility platform. He raised money from multiple, angel investors. He then exited the venture when the company was acquired by one of the investors, after which he went to IIM Calcutta and graduated from there. So this is the intro to the panel. Welcome everyone. So I will start the discussion. The first question is Ganesh. So Ganesh, just to get a sense of the competition which startups face to raise VC capital, can you just let us know how many companies, approximately approach you in a year, and how many companies do you actually fund? If you can take us through the funnel to help us understand the intensity of the competition, and also if you can outline the reasons why companies get dropped out, in your evaluation process at various stages. So over to you, Ganesh.
Sure. Thanks, Samir. I'll try to keep this brief. I think I've already spoken too much. So, just for context, we are a specialized fund, right? We invest in sort of fintech and related verticals to fintech, like commerce and fintech overlap, or logistics and fintech, education and fintech, health and fintech, but it's still more sort of financial services oriented, and hence we are more targeted. So generally, I would say in a year, let's just take India as an example. Out of all our markets, we would probably sort of go through plans, whether in a cursory way or have a single meeting, or go beyond that, maybe with 200 companies, I would say, somewhere between 200 and 220, of which it's likely that about 25 to 30% will probably go to the next stage, and it could be various reasons, right? Stage of business, fit portfolio fit for us, quality of entrepreneurs, or the idea, evolution of idea, capital being raised versus what we think makes sense, etc. Then at the next stage, once we, then you have to kind of dive deeper on a number of other things, whether it's understanding the plan better, market. Sometimes, there is just getting a better sense of entrepreneurs in themselves in terms of how they think and all of that. So I would say that 25 to 30% list will probably, come down by other 2/3 at that stage. And now for the remaining is where we probably end up spending a lot of time. And sometimes it could be like a few weeks process. Sometimes it could be a 3-quarter process where you like the company, you have there's the mutual inclination to work together, but it might take a couple of quarters for them to go and do something and come back, or a quarter to go and do something and come back, whether on hiring, whether on business side or whatever. So I would say it eventually comes down to probably about 8 to 10% of the total list we see where we will spend a fair bit of time, and of that, maybe eventually we'll invest in 4 to 5.
Okay, great. So I'll now move to Abhishek Sharman. While tech startups and investments get a lot of press, there is a bigger world out there for growth capital investments in non-tech ventures as well. Abhishek, you have been doing this for 15 years now. Earlier at Sun PE and India Equity Partners, and then now at Carpe Diem Capital. So, what is your philosophy for catching, high quality winning companies early in the life cycle?
So, we have a tried and tested approach. We believe that you see leadership skills in companies fairly early. We look at companies which are between 25 to 30 crores at the lower end and 175 to 200 crores at the higher end in terms of revenues. And in these companies, what we're looking for is essentially two or three things. One is that they can be defined as leaders. We can be very creative in the way we define leaders, but usually leadership is in a geography or a subsegment. That to us is important. And secondly, we want to see some strong proof that the company can live within its means. So they should already be in some ways EBITDA break-even or profitable. To us, that's a very important aspect because let's say you put in money and there is largely growth capital, expansion capital, and you do whatever you want to do with it. You set up more stores, or you go to new markets, you hire more people. Now, if that doesn't work out, if the company has the DNA to be able to cut to a certain size where they can again be self-sufficient, then you know that you will live to fight another day. So to us, the two key tenets is that, we want to focus on companies which have the ability to be self-sufficient. We want to focus on companies which have shown some characteristic of being leader. And third is we want to ensure that we have got strong alignment of interests. Usually we back first generation entrepreneurs. Usually we take very significant stakes in companies, 26% plus. And then we employ a variety of other methods to ensure the strong alignment of interests. So I think those are the key aspects of what we are trying to do. And in terms of our theme, we are always trying to back creation of a consumer brand or creation of an organized service, because to us those are the two most compelling opportunities in India at this point in time.
Sure. Thank you, Abhishek. That's very useful. So from the investor side of the table, now I'll hop on to the company side. So my next question is to Anindita. Anindita, healthy food options have generally not evoked a lot of investor interest, simply because it's perceived to be a small addressable market. However, things are now changing for the better with heightened levels of consumer awareness. So can you please take us through the trials and eventual successes of raising funds across multiple rounds that have taken place in your company?
Good. So we've primarily raised 3 rounds of funding till now, 2 from Fireside Ventures and 1 from Self Partners. And you're right, when we started in around 2013, a lot of people that we used to go and talk to used to be like, health doesn't sell in India. India is a taste market, health is not going to sell. And that was not only from the investor community, not only from people in the investment community, even if you went to a retailer and asked them, listing and things like that, it was always like health doesn't sell. India is not a health conscious market. Health will not sell. It's always going to be back to taste. So I think we were lucky. I don't know. I think it was a lot of perseverance, and also in the beginning there was. So we raised funding even from friends and family right in the beginning. So I think got a little bit of impetus through that. We got some funding from banks as well because we put up our own manufacturing facility and things like that. So there was a little impetus which came prior to going into a proper formal funding round, which helped us kind of like establish market, helped us establish if we were able to sell in the market, is it something that we could sustain for some more time? So it helped us internally tick mark some of those boxes because every time we went to the market, we kept hearing that health does not sell, health does not sell, health does not sell. I think the shift in consumer perceptions consumer wants has actually been happening for the past 4-5 years. I think the last 6 months, obviously, there's been a heightened sense of it, but I think the main driver which actually shifted, which created that shift was more Amazon entering the market in a more and expanding out the market for going more D2C, which kind of like changed dynamics for a lot of people. I think that was more of a turnaround kind of point. And the change in I think a few other, so it's always the ecosystem which grows also, right? So you had people like a Godrej Nature Basket or Food Hall, which also went into more niche categories, and we're very like sure that those are the kind of categories that they were going to grow in. So so it was kind of a little bit of the of the entire ecosystem evolving past just the big brands, because I think pre 2010, I think most of the FMCG things that were selling in the country was pretty much HLL, Britannia, Dabur. I think between those 3-4 companies, everything they pretty much cover probably 80-90% of products that were selling in the market. But I think at the same time, a lot of these developments happening did give us a break in terms of meeting a customer and things like that. So that's kind of evolved a lot in the past few years.
Sure. Thank you, Anita. I will move to Pawan next. Pawan, your entrepreneurial journey started at IIM Calcutta campus, where you co-founded Jostle with 6 other co-founders. Take us through how it all evolved. Also, do share with us the story behind bagging funding from Tiger Global within about 2 years of Jostle journey.
Sure. Thanks a lot. So, ours is a rather interesting one and a little more, the role of IIM Calcutta is a little more than probably a usual startup story because it all started in the campus. We were 7 founders actually, out of which 4 of us were batchmates in IIM Cal, and I'm a 2012 to 14 graduate. So right after first year, we all came back after our summer placements, and one of my friends, and ex co-founders, he was from the hospitality business, and he basically came up with this idea that, hey, how about we start backpacker hostels? And all of us during our undergrad and even in IIM Cal had gone to Europe for exchange program and have stayed in these hostels and have been super fascinated about the idea of staying in hostels, right, youth hostels, and it was not that prevalent in India. So very quickly, I think everybody was on board. Anyway, the whole of second year in B school is something, when people like to while away their time, either watching movies or just generally partying. A lot of people go to their exchange programs. We on the other side decided to actually start this as a hobby project, but I think in the matter of a couple of months itself, it got really serious, right? All of us pitched in I think 3-4 lakh rupees each, got a corpus of about 20 lakh rupees, and some of us in fact were running our education loan, so we actually had to beg, borrow, steal from our batchmates and everyone, got these 20 lakh rupees and started 2 properties, one in Jodhpur and the other one in Jaipur. And I think in a matter of a couple of months, we could see that properties are reaching break even. People who are coming on board are simply loving it. And there were 3 more founders who were like hands-on operating in those cities, right? So it all started making sense and suddenly drew a lot of attention. All our batchmates, juniors, seniors. In fact, there's a good vibe in the media as well that these IIM Calcutta graduates have started this backpacker chain, of hostels. And it all started like that. Of course, when it came to financing, our first bit of financing, post the initial 20-25 lakh rupees was through business plan competitions. So there is also an interesting anecdote here for maybe, people who are attending this out of their business schools. So we applied to one of the B school competitions in the second year. And we realized that, like in a matter of a couple of hours going there presenting, we won, I think, 1 lakh rupees of first prize, right? We thought that this is actually a good way to raise some capital. And over the next 2 or 3 days, we ended up applying to each and every business plan competition which is available, which is going to get conducted in India or abroad. So, and I think in all over the next 3 months or so, we participated in 16 business plan competitions, out of which we ended up winning 15 of them. So it was a fabulous, it was a fabulous run for us. We raised about 55 odd lakh rupees, and it also suddenly got a lot of, attention from investors, media attention. And all these were like some really prolific B plans, right? For example, we won IIT Bombay's Eureka, we won Richard Ivey Business Plan Canada, India, Water India Economic Forum. So we won some really top level accolades that way. And that's the time when we were about to graduate. Luckily we had a term sheet, a seed round, term sheet before graduating. I still remember most of the folks were, going dressing up all in business formals for their placement interviews while we were like negotiating term sheets. So it was a great experience. We graduated in 2014, scaled Zostel the whole of 2014, but very soon realized, I mean, we were 7 founders, and like there was a lot of firepower, in the team, in the founding team itself. And very soon we realized that maybe Zostel as an opportunity, or the backpacker hostel as an opportunity, as a TAM is not that big. And somewhere towards end of 14, early 15, we thought, how about you enter into the whole budget hotels model, something like what O was doing. It was, I think, a couple of months ahead of us in the market. So we also added Joe Rooms as a brand to the portfolio, and that also, of course, drew a lot of attention, which was not earlier being given to something like a hostel, right? And we went about raising that capital. Tiger happened. We were fortunate that Tiger happened, but I think a couple of months before, we met Lee Fixell, who was heading Tiger. We were actually raising money. We ended up, we took a term sheet from another prolific investor, and that term sheet actually fell through at the last minute, right, on the eve of the SHA. And we were like literally running out of money. And we got to know that, Tiger or Lee Fixell is basically traveling to India, and we already had a meeting scheduled with him. We somehow managed to pre-schedule that meeting, prepone that meeting, and meet him. I think we met him at 7 p.m., on 14th of April or May, one of those, 2015. And probably in next 12 hours, next day, 8 a.m. in the morning, he was like, he's happy to sort of partner with us. So that was a pretty thrilling experience. Yeah, and of course, we ended up scaling a lot from there on. The whole of 2015 was all about scale and, I would say blitz scaling.
Great. That's a fascinating story, Pawan. Thanks. So I will next.
By the way, I can also tell you that out of that initial 20 lakh also, one of the founders actually contributed some 7-8 lakh rupees, which he won by winning a poker tournament on PokerStars.
Wow.
So so it was literally like, we, from pennies to millions, that kind of a story.
Fascinating. Great. So I will next move to Pratap. Pratap, raising money from VCs is one part of the equation. Sustaining and enhancing the demand from investors in the subsequent rounds of equity raise is quite a different ball game. So, having done it successfully, can you throw some light on what went right for Quicksilver during successive rounds of fundraising? Having raised multiple rounds over the last decade, how does one ensure increasing interest, investor interest? So, can you throw some light on these topics?
Am I audible?
Yeah.
Thanks, Samir. It was good to get this download from Ganesh, where he's probably captured our own journey of the last 10-12 years in those 2-3 slides. Lots of things we have gone through, lots of things we have not gone through, lots of things we have done contrary to what he has advised us to do, as those green things we have done. We have not done those green things, but still we have survived and carried on. So Pawan talked about they setting up on campus, so fantastic. I come from the era when I was on campus when Manmohan Singh announced the liberalization of India. So I was 91, 93 batch. So that's when, we had this, and Manmohan Singh was the chief guest for our convocation when he was the finance minister. Wow. So I guess I'm in that era of past and present, so bridging you guys. So just to give you, in my time on campus, we never had this wildest idea of setting up a company together. हम तो कर रहे थे, जो भी पवन कह रहा था कि what we do in the second year. I did that in the first year and second year. Whatever, in the sense,
Smiling that time.
to know people, getting to know life within campus, outside of campus, and attending classes sometimes. And but a party pooper here. So we are a fintech company, we are a SaaS company, we are a consumer product company. All that over the last 10-12 years. But confession to make is we are a fintech company, but I made a B minus in my FinTech course on campus. So that just goes to show probably, or the college degrees or the grades don't matter, or probably it's one example of that. So you wouldn't find my names on any of the boards up there on campus. And lots of other batchmates of mine are there whose names are very illustriously put up there. So the last 10-12 years journey, we've seen, okay, you talked about you've referred, you mentioned our investors, four VC funds that we raised money from, Axel, Helion, Amazon itself. We were the first startup in India, technology startup that Amazon invested into in India. And we were surprised then. And after that, there's this Russian fund called Systema. Their Indian arm invested into us. And over the journey, in fact, we had our own VC fund itself, which went into mergers. So we were invested into by a fund called by a VC called Erasmic. That was the original avatar of Axel. Erasmic way back in 2006, 7, 8, when Axel from the US came into India, they bought out Erasmic, and therefore we became part of the Axel portfolio in India. So before that, Axel did not exist. So I think like a lot of anecdotal old man moss wala feeling to I'll have these kinds of tales to narrate about. So I come from the era when SaaS was not sexy. VCs were very hard to find. Startups were not the coolest thing to do as compared to. So Pawan and gang set up a company on campus, which was so cool in our time. So find a job for yourself, guys. And we come from a proper South Indian family of parents from public sector. So naukri to chahiye tha pehle. Somehow we just wandered into IIM Calcutta because we just managed to crack CAT and get into college. Uske baad to naukri to chahiye tha. So there was no aspect of fixing up a company, but it's fantastic now. So the goods and bads, okay, a lot of things that we did in life was not without, there wasn't any handbook on how to go about it. A lot of it was shooting in the dark. A lot of it was our own gut. And our gut was more often than not wrong than right. And but what just kept us going along the way was that we just stuck to our knitting. And we said gift card. I think looking at it from a VC's perspective, I think it's so much more challenging for them, like Ganesh alluded to also, because there are, you yourself asked Ganesh about the number of pitches they get. I think each of us are believing that we're going to change the world in our own domains of experience, and it's going to be that much more difficult for the VCs, I would believe, yeah, because who do they believe, who do they not believe? Each of us will have these fantastic tales of how we're going to change the world, and there's nothing of that existing at all right now. Same thing with we said we're going to change the way of gifting in India. They were very polite to us and said lots of the VCs told us bakwas, not in as many words or probably in as many words. Who's going to do this? India is a cash country. India to shadi gifting karoge to dabba leke jana hai shadi pe. And how big is a dabba, that matters rather than a gift card. It's very cold. It's very impersonal. So the best of VCs have told us ki nahi chalega. So I guess each of us has gone through that in our respective journeys, that we've heard more no's than yeses, right? And so what kept us also going was that in a way we had two other co-founders. We would just laugh it off. Probably today the startup community, there's I think there is a rat race amongst the I guess startups now to get funded. In our time, there's no past, there's no precedent. Chalo yaar, dekha jayega. If we screw it up so badly, so be it. Yeah. We'll always find something to do with ourselves in our own lives. But there wasn't a big something to live up to, a big reputation of having succeeded to even measure. We didn't know kya hone wala hai. We just thought we built a great platform. We believe we built a great platform, and we'll get into this. And one of the investors, so Erasmic, again they said, "So ठीक है यार, इतना चुप बोल रहा है कुछ." And US में तो of course gift card industry is a huge industry. It's $100 billion plus industry, and like Ganesh himself said, lots of the VCs are not founders themselves, but they've come from the US. So gift card is a known terminology from the US. So some of them had seen it, had seen the potential, had seen the actual category scaling up over a decade in the US in the 90s and early 2000s. So they just thought that, okay, we'll put in some money. So before that, we had raised some monies from friends and family. And then Erasmic first put in. Then Helion, we pitched to Helion also at that time. Helion, there was Ashish Gupta and Kanwal, who's now Fireside.
Yeah.
But they said, okay, jamega nahi, gifting in India. But when Erasmic decided to put it, then Helion said, we'll also put it. But we don't, it's too small for us to even spend any bandwidth of ours on thinking about this company. So if one of you is going to do it, if one VC, that is, if Axel is going to do it, then we will also put in. But Axel will kind of manage this company on whatever they say they're going to be doing. So that went on, and so one good thing for us, which again probably got us repeat rounds, was that we were able to achieve all that we set out to do. I'm talking of the metrics. It's not to say that suddenly we had some great vision that hum jo keh rahe the, we will meet, because we're talking of a zero base. And okay, next year we will do X amount in 2009, 2010, 2011. Each of these years, okay, we'll have itna equivalent of GMV, equivalent of number of customers signing up, equivalent of number of cards. And it wasn't any scientific. I mean, we tried to build some kind of methodology, bottom up, top down, and even raising funds. We'll go with a bottom up approach. The funds would tell us, give us a top down approach. We go for the top down approach, they'll tell us do a bottom up. So all kinds of we have 25 different Excels of all kinds of top down and bottom up and lateral and horizontal models to arrive at what we're doing, why we're doing. Because there was no syndicated data or syndicated reports available of what is this category all about. And we say we're going to change India. So that is the context in which we operated in. So the first round came in when they both came in together, which is Helion and Axel. And because we kind of were able to meet our metrics year after year, the second round again, they evinced interest in kind of keeping invested in us. So we didn't have to go to anybody else to kind of raise monies. Along the journey, while we were having a supposedly fantastic 2020 vision of how the category will grow, but from the VC side, they couldn't fathom what we were doing.
Okay.
So we had to give somebody, because today there's always an example, like when Flipkart came in, they said, okay, we are going to be the Amazon of India. So very easy to figure out. Now, there's always, we will be this of that of this. We will be the Uber of this industry. We will be the this of that industry. People are able to relate to that. Hamare category mein, even the gift card category is not very VC, let's say, friendly. VCs have not invested into very many of our category on the fintech side also. It's so there was not a precedent, but we were very clear that as first generation folks, we will need to have a VC backed company. One, because we were first generation, it would help to have a good VC team, quote unquote, advising us or even whipping us or whatever, but rather than trying to do it on our own. So we were very clear that we should be doing that, and that's what we had even kind of worked towards modeling ourselves. But at the same time, we were mindful that ठीक है नहीं होगा तो ठीक है क्या करेंगे. That was our approach along that. It should be a VC/PE driven entity that we are working and scaling and growing. And so the good thing or the bad thing was there was nobody else doing what we were doing. Again, Ganesh mentioned that there will be lots of other copycats coming into the category. हमारे category कोई आ नहीं रहा था. We wondering boss क्या कर रहे हैं हम लोग? Why isn't anybody copying us? Why isn't anyone even venturing into what we are doing? Either are we so great or are we kind of doing something so stupid that nobody wants to walk down our path? So we built this technology SaaS platform company, going to big box retailers, going to big box enterprises, saying that we will manage your gift card portfolio for you. So we go to the Tatas and the Birlas and the Ambanis and each of them. None of them believed us. Why do Tatas will tell us, why do we need you? We've got a whole TCS with us. Why should we need a 5-member team of startup with a badly spelled company sitting out of a basement in Quona? Why do we need you? But one thing led to another, and we just had sign-ups one by one. But what we had not, so the fact that the first stage was the metrics were getting signed on. So we're very clear that we will approach enterprises who are leaders in their respective domains. Again, India being India, clients being clients, enterprises being enterprises. I mean, it's hard to crack an enterprise deal. SaaS, nobody knew what SaaS was. A startup community, there wasn't there. And we're talking going to the biggest of retailers. And at that time, the scenario, we're talking 2008, 9, 10. It was only organized retail itself was picking up then. It wasn't a scenario where it was established. So they were busy scaling up their own business, leave alone gift card for their business. They were busy opening up shops, opening up stores, rather than looking at a startup providing gift card category services. Along the way, e-commerce came about. So we weren't too hopeful about e-commerce in all our worldly wisdom. Who's going to buy jutas online? Who's going to buy garments online? Come on, India is a country where we like to go to a dukan, go to a trial room, wear it. कौन चलने वाला नहीं है, मिंत्रा चलने वाला नहीं है, कौन खरीदेगा? But and we were very hopeful that offline is going to rule, because in the US offline, every big box retailer and every mom and pop store in the US has gift cards. So in India also, India is a market of grocers. India is a market of shopkeepers. So we built a great platform, so we believed. And offline with the chalne wala hai. Along the way, online came about, and we just signed on a few online players. We met with Sachin and Vinny when they were operating out of the same basement in Koramangala. And they believed in gift cards because they come in from Amazon, and Amazon's gift card portfolio is huge in the US. So they believed in, they're so busy doing their own things that gift card ke liye they decided to work with somebody. They could have built it themselves. Thankfully, they did not. So they kind of integrated it into our platform in 2009-10, and tab se so Flipkart. But not that we were expecting, but they had a fantastic UI then, of course. So as consumers, we love Flipkart, but we never in our wildest vision expected Flipkart to become what it was going to become then. But we had to keep ourselves busy, right? The big retailers were busy opening stores. So where do we get the time to get something? Some proof of concept needed to be there. That's why Flipkart came about as a proof of concept. And along the way, in 2013, Amazon came into India, and we approached Amazon, and they were looking for a third-party provider. India is the only market in the world where they actually outsourced the gift card portfolio to a third-party startup. And when 2013-14, we were in the market to raise again another round. But Helio and Axel wanted to again, but then they had invested into us from a fund where they didn't have any more money to invest into us. That's another challenge which was the sheer life cycle of a startup. Even if there are scenarios where the VC wants to invest, but in their own books, they can't invest into the same startup from another fund. Actually, that's what worked or did not work for us. So they wanted to, but they could not. And even exits were far and few in between. So they invested into lots of startups. They can exits nahi the, so they couldn't invest into QC, into Quicksilver, although they wanted to. And by then we had signed on Amazon as a customer. So when Amazon got to know, the business team of Amazon got to know that we were in the market for raising monies, they said they would be interested. surprising ye kya hai, and that's how Amazon came into investing into us. And what has helped us consistently, as I said, is meeting the metrics and that we set out for, without being able to actually being too sure of whether we are on the path. We were we would say lucky, we were fortunate, all the forces conspired to make certain things happen, and so that's how it is. And so these four rounds, two investors have been there over the last 10, 11 years. Amazon invested. We were surprised when they invested, but even more surprised when they decided to. They came in as a financial investor, and when the exit happened last year in 2019, each of the VCs had a cash exit, which was one of the few instances in India where, for one, it was good for a SaaS company. It was good for probably, I guess, just a story for the investors itself, that there is potential in India for cash exits to happen in India. And again, as a team, we kind of we weren't looking for an exit. Again, the VCs had to have an exit because, again, their fund was coming to a close, so they needed an exit. But while the investors exited 2019, last 1.5 years, since we've had a new set of investors, so to speak. We are the investors of Pine Labs invested into Quicksilver through Pine Labs, but all of us continue in the company. So that's in a way helpful that the team has been together, both pre-fundraise, during the fundraise, as well as post-exit. That's kind of helped in scaling the business to an extent that we would not, which would not have been possible had it not been the case.
Very,
I guess 12 years trying to capture it into 5 minutes is difficult, but I guess I'm having to do as much as I could in this. I hope it was relevant, useful.
Yeah, very useful, Pratap. So if I can distill some of the things that you said, I think you were in a way pioneers in this market. So the market was very small when you started, and it kept expanding, and thanks to your efforts. And I think the team was very solid, product was very solid, and you kept outperforming your own projections, which continued the trajectory of investor interest. So thanks for those insights. I will now move to Ponappa. Ponappa, from now we have had a chat with VC investors and then startup founders who raise VC money. I'll now come to Ponappa, who has often recommended to startups to think beyond VC capital. So Ponappa, can you please elaborate on this strategy a little bit, because there's there's a world out there which runs on non-VC money, and they continue to make profits, survive, thrive. There are a large number of startups in that bucket as well.
Thanks, Samir. Pleasure to be here. I didn't realize that I was the senior most guy in this group. And just as a background, I passed out in '86. And in '86, we were the first occupants of the White House. Matter of fact, when we moved in, there was still construction work happening, and the ground floor was not being able to be occupied because rooms are not done and stuff like that. The other interesting tidbit was that on campus, there were 4 computers at that time. So we were roughly 240 students between the 2 batches. And to get access to those computers, if you want to do anything in computers, you have to wake up at 6 in the morning and go and register there. Otherwise, you could not get space and time. So for many of us, that was too much of an effort. So we didn't even see the front end of a computer till we passed out. But anyway, to come to the question that you asked, Samir, what I landed up doing was quite accidental. This was not planned. This was not a long-term strategic option that I had. I started mentoring my first company while I was running AOL in India. This was around 2010. And I really liked what I was doing, playing the role of a motivation guy, a strategy bouncer off guy, some of the points which Ganesh had mentioned. And I really enjoyed what I was doing. 2012, I actually decided that maybe there's an option to do this full time. And I'd already spent 26 years in corporate India. I'd been a CEO for 11 years. It has already been there, done that. And now the whole thing was, what can you do next? And that's when I started to try this thing that can I be a mentor come angel investor in the startup ecosystem? So I went down the path, started working with a couple of companies. That's when you realize that the odds of getting funds at an early stage from a VC, like Ganesh was talking, are really low. It's very tough for a VC to decide. And it's even tough for a startup to reach that level where you can be on the consideration set of a VC for multiple reasons. You may have the best thing, and like Pratap has very nicely captured, some top VCs have passed saying, "Ye to kabhi hone nahi wala hai." And they've obviously come back and regretted it later. It's very difficult to take these decisions. So when I was working with some of these companies, and when you start working and you realize that there is serious potential in it, the first junction is how do you raise money to move it to a scale by which a third party who can look at it sees the metrics and makes sense. So over a period of time, and I've been doing this now for roughly 9 years full time, so I have some experience and learnings that I've distilled in this. So the first type of funding is typically what I call faith and trust funding. Sorry. So these are faith and trust funding is a team which typically knows the founders. You will typically not be able to raise too much money in this because, see, in India, typical ticket sizes for an investment is 10 lakhs. Typical. I mean, you may be lucky to get more, but if 5 of your friends are willing to support you, that's about 50 lakhs. Now, the key thing is, and after this first round, is to be able to reach some metrics where you can go to what I would call high-risk angels who like ideas, like concepts, and want to see mota some metrics, very, very little metrics, but are willing to take larger bets in this stage. And you can then raise, anything from 1 to 3 crores from these type of people. And here, these people typically have larger pockets, would typically be a CEO of a large company today. For him to write a 25 lakh check is not a big issue. But he will want to see some metric which is more than just an idea, typically. Yeah. After this, you come to the third level, which are the follow-on angels. Now, these angels are the mass market. This is typically any guy who's a senior corporate executive in India today, easy for them to write a 10 lakh check, but they don't have the ability to take the high risk bet. And they want more metrics, some product market fit, at least, say if you're talking B2B, they want 10 customers. If you're talking direct to customer, then maybe 10,000 customers, some numbers which are understandable for them. And they will follow with the fact that, oh my God, those guys have already invested. So they have done a DD. They are good guys. They are good names. Then I'm willing to come on board. I'm not saying that VC money is not needed, but there's a time at which VC money becomes relevant and easy. I've seen companies who have spent so much time chasing a VC, and it's a binary decision. You could spend 4 months sucking your time, and then the guy says, sorry, for some reason, we're not doing it. That's very tough for a founder because he spent maybe 30% of his time playing that, and he's compromised on metrics, he's compromised on many things to be able to reach that. So what you're just trying to do is using angels, reach a situation where your odds on chance for a VC become so much better. One of my companies, and many people who know me know that I've been mentoring a company called Perfios for many years. And when Perfios started their journey, most companies said data aggregation, data analysis for banks is never going to work. And I was part of pitches to tier 1 VCs who all passed it. We went down the angel group, we raised reasonable money to a level where we were almost break even as a company, and we had almost 40, 50 fintech companies using us at the back end. And then the VC wanted to invest in us. So it becomes an easier sell when your product market fit is a little better, and you're then looking at maybe just Series A or Series B. The other thing which happens sometimes when you raise good angel money is that you can potentially skip a typical Series A, the 3-5 million range, and literally go to a large Series A, 10 million plus range, because your metrics start getting so much better. But for that, it is a full-time job, and it does suck a lot of time and effort for the founder. And typically, many of the companies where I mentor, I actually play a large role in this, and which is what when I was sharing with you, a large part of 10% of my IAM batch I've invested in some of my companies in some form or the other. Wow. So that's how this whole ecosystem grows. but you need somebody who will be able to literally handle this in a reasonable process, because it sucks the hell out of time and there will be no's every day. A guy who invests in one company will not invest in another company, and it's a humongous task, but it at least improves the odds on chance of a company raising some money and reach a better milestone, at which junction it becomes easier to get serious VC capital. That's the story which I've been able to.
Yeah. So I just have a follow-on question, Punappa. So, like you mentioned, some of your portfolio companies have eventually raised VC money. So, specifically from fundraising perspective, what kind of preparedness did you ensure with those companies before the VC conversation started? Can you take us through this aspect?
I don't think there's anything drastically different there. It is like you would typically do for any VC, except that you will target a VC who is now not an early stage guy, but maybe a mid stage, later stage Series A funder. But the metrics are the same. The BD, which is the same. You will have to do a huge metrics about what your plans are, what your prospects are, what are the chances of the potential revenue streams. It's a full-fledged thing, and there are professional iBankers who will actually do all those scenario plannings. So it's a serious game, but you have to do the entire full 9 yards when you're raising say anything upwards of 5 million.
Got it. Great. Sure. Thanks, Punappa. So I will now move on to Sudhanshu. So Sudhanshu, after graduating from IIM-CAL, he worked with Adani Group, like I mentioned very briefly, and then he got on to his entrepreneurial journey. From what I hear from organizers, he's a very perseverant entrepreneur. While the VC ecosystem has still not warmed up the opportunity in the sector where he is operating, but he has been at it, with a lot of discipline. So Sudhanshu, my question to you is, when you have an ambitious plan in place, but like I mentioned, VCs have still not warmed up to the opportunity to invest in this sector. How do you sustain and keep your motivation high and wait for the VC tide to turn in your favor?
Yeah. Thanks, Samir, and as well as for the organizers to actually invite me to the platform where probably most of the guys in the platform I have either raised money or have invested in a startup, and I'm yet to probably be in the phase where we will be raising institutional capital. But yet, answering the question, yeah, definitely, like most part of your question is actually answered by Pratap for me. Like in the time when your space is not actually heated up, when you are yet to see interest of VCs in the sector which you are operating, obviously perseverance becomes a very important key. And as I think another part.
Sudhanshu, just to, sorry, Batin, can you just put on your video? We can't see you.
Oh, sorry. Extremely sorry. Can you see me now?
Yeah. Thank you.
Sure. So the next part like is something which has been as mentioned by Quona, like for example, when the space is not actually heated up by VCs for a particular sector, all that is required for you is to get a validation from an early customer, and that is something which we are doing at the moment. So I think that is something which I want to answer to that.
Got it. Thank you, Sudhanshu. I will now move on to Gyan. Gyan, you decided to exit your venture, Efficient, by getting your team acqui-hired by one of your investors. And the primary motivation for the same was also because the company wasn't scaling up to your satisfaction. Although you raised a good amount of angel money from fairly reputed investors, you then went to IIM-CAL for your higher studies. So what are some of the key lessons that you would like to share with us, especially in the context of equity raise?
Sure. Thank you for having me, folks. So we started Efficient in 2015. I was leading North India sales for a SaaS company then, and realized I was working very closely with the founder and realized there is an opportunity in the market in the mobility space, wherein what was happening in India is if you look at West and China, people started with desktops, came onto laptops, and then went on to mobile devices. In India, everyone was directly getting exposed to internet onto mobile devices directly. And we thought, though mobility has picked up on the B2B side, there is a lot of opportunity on the B2B side wherein you can have greater employee engagement, greater flexibility, probably enable remote working if you can take the business side of things on mobile devices. So that was the thought process behind Efficient. Uh, Talking specifically about my learnings, from my fundraising initiatives, and I have written extensively about it. I like to focus on two of the key learnings that I had, and these two are close to my heart because I've been consulting a lot of startups for last 2-3 years, and I see many of these guys making the same mistakes. One of the learnings I had pitching to a lot of these angel investors, that you can't pitch to each and every investor you can come across. Like it's not like everyone is going to invest in your business, and it's not like everyone is made to invest in your business. So if you are running a B2B business, probably you want an investor who can take you through corporates, who have the CEO connects, or who can guide you on how to flesh out the GTM correctly. A friend of mine, just to give an example, a friend of mine who was running a B2B business raised money from politician, right? So these sort of things do not work out. It's important for you to figure out who is the right guy to invest in your startup. Why do you want to raise money from him? A lot of times these founders, especially when who are right after who start right after engineering institute or something like that, they probably don't value themselves much in terms of they want to have money from wherever it can come from. So I pitched to when I was raising money, I had maintained an Excel. I still have that. I pitched to close to 110 investors and finally raised from 18 investors. Imagine the kind of energy, the mental energy, the physical energy that goes into each and every pitch. And I pitched to VCs, I pitched to angel investors, I pitched to whoever I could get hold of. But another thing why all these guys were giving me time was that we had very good quality lead investors, right? So all of these guys were like, yeah, इस बंदे ने invest किया, देखते हैं क्या है startup. Although he had already decided, yeah, I am not going to invest in this thing, right? And now looking back, I feel as an angel investor, you should be investing in a startup if you can add value, or if you know there is someone else who can add value, right? And probably you can piggyback on his experience, because a startup founder expecting you to make you to probably help him scale and make him a VC fundable startup. So this is one thing which I feel could have been so. I there probably even in the angel stage there was no VC except for Tiger and SoftBank, whom I had not pitched to. And imagine you are preparing for a pitch, and all that you get to hear after the pitch is that you are too early for us, right? So that's something that could have been avoided, and I highly recommend entrepreneurs to kind of figure out whom they want to raise money from, or the guy they are going to pitch to, what his investment thesis is. Is he really going to add value? Is he going to invest? The second thing which I feel I could have done a better job of was focus on what the investors want to look at. So what happened is that the SaaS startup that I mentioned with which I was working, their product was not really top notch, right? So I when I started up, I used to feel, यार मैं ऐसा शानदार product बनाऊंगा कि मतलब हर कोई पैसा लगाने के बिल्कुल तैयार होगा. And we focused a lot on the product, right? We did not really focus much on the sales side of things. Now when we went to pitch to the investors also, it's okay, you have built a great product. Really congratulations for that. We had NASCOM recognition, we had a recognition of Entrepreneur India, and we had some lead investors as well, who had probably invested based on a product, or these guys had different sort of philosophy. But most of the angel investors, and we were too keen to focus on the product, and these guys were not too concerned about the product. They were like, tell me who are customers you sold it to, who are you, right? Who is the target segment that you're going to go after? What is that you achieved on the sales side of things? And we were actually not ready for it. We always thought that because we have built a great product and we are going to get funded, like everyone is going to extremely excited about what we have built, and they will be funding us. Surprisingly, it's not. Since, like I mentioned, I've been working with a lot of startups over the last 2-3 years. Only 2 days back, I came across a startup very seasoned entrepreneurs, though first-time entrepreneurs, but veterans of the industry. And I was surprised to see them making the same mistake, which probably just engineering pass outs do. So it's better to focus on the matrices which make sense for the which make, because these all these angel investors and these VC are pretty smart. They know where actually the challenges lie. You can build a product, but it's difficult to sell, right? At least to Indian enterprises. And selling takes, as an engineer, you can build a great product, but selling takes a different appetite altogether. So they'll evaluate on those parameters as well. So these were the learnings I had, and yep.
Yeah. Great, Gyan. Thanks for all those insights. And you, as you rightly mentioned, a good advisor, mentor, early, in the life cycle of the company can make a big difference. So I have another question for you, Gyan. So quality of your product, you talked about building a great quality product. So quality of a product gets initial traction, but eventual success occurs due to business fundamentals. Things like, are we pricing the product correctly? Are we scaling up the business rapidly enough? So solving for questions like these, maintains the growth momentum. So how important is founding team composition to solve some of these challenges?
Like I said, the second problem that I mentioned, that we didn't focus on the right set of matrices that we're supposed to, that the investors expected from us, being businessmen. We were not just engineers, we were businessmen at the end of the day, and they expected us to focus on the right set of matrices. Who are you going to sell to? What is that price that you are going to charge? Why is that you have the right to win? Why would a particular competitor not wipe you out? So it's important to have a founding team which kind of complements each other well. We were both very engineering heavy at that point of time, and these are some of the things we could not really focus on. I'll give you a simple example. When we realized that we have to focus more on sales. Doesn't matter how many investors we reach out to, we are going to have the same feedback again and again, that the initial traction that we are looking for is not there. So we decided, okay, boss, now we have to close some customers, right? Yeah. What we did was, so we had an enterprise mobility platform. What we did was, the first three customers that we acquired were Axis Bank, Dalmia Cements, and Hindalco. And now we got pretty excited that now things are sorted. These are good names to have, and let's go to the investors. Then the feedback we got was what is that you're trying to prove? You are not a horizontal company, you are not a vertical company, you are a platform, and you have these three customers which are from different spaces. One is into manufacturing, one is into banking, and what is the story behind it? What is the DNA of the company? Are you going to target manufacturing? Because you can't target everyone at the same time, right? So these nitty-gritties like this should have been figured out in the very beginning itself when we were fleshing out our GTM. Like I said, it could have been some angel investor who would have mentored us, or some advisor who could have mentored us, or we could have the complementary skill sets in the founding team that could have helped us, sharpen those particular things.
Got it. Great. Thank you. So my next question is to Pawan. Pawan, you mentioned blitz scaling earlier in the discussion. So blitz scaling always gets VCs more excited. So can you share some hacks, that you particularly used for rapidly scaling up in the early stage of the companies, both your earlier venture and the current venture?
Yeah, I think it can be without sounding very very generic. I can tell you it's all contextual, right? I think at the end of the day, if you are, it really depends on the kind of DNA you are building in the company, right? Sometimes what happens is that you are in a phase where you are figuring out the product market fit. At that point of time, what's required is you need to tweak your product multiple times. You need to have a lot of iterative testing. At that point of time, the speed of development, the speed of market is something which it is important to get the right mixture or the right composition when it comes to achieving a PMF, right? Once you sort of cross that stage in the business, let's say you're in a space which can get highly competitive. I mean, give you an example. For example, in 2015 when we entered Zorooms, Oyo was already there. They were a couple of months ahead of us in terms of the business, in terms of financing, almost in all uh, measurable metrics, they were ahead of us. And the market was also heating up really well. So we had, of course, one large player ahead of us. We were number 2 in the category. And then we had at least 4 or 5 other VC funded ventures like Fab Hotels was there, Tribo was there, and then at least 15 to 20 folks who were trying to become, like who were trying to raise VC money to sort of become relevant in the space and gain a lot of traction. So that is the point where there is a lot of there are a lot of ways you can play that game, right? I mean, you need to stay relevant in the space. You need to also have a good tight handle on your unit economics. You need to also make sure that the organization, the speed at which you are growing your organization, because Zorooms, for example, was a purely ops heavy business, right? There, we ended up hiring about 500 odd people in a span of 8 months. Now, the overall culture can totally go for a toss when it comes to that. So, I think it's really, really critical to keep a good handle on, on your, I would say, on your steering when you are pushing the accelerator. Because that can actually do a lot of damage. And I have actually seen, I mean, since we are openly discussing, I wouldn't call ourselves, we were very, very proud of the way we scaled in Zorooms, right? That wasn't the right way to scale. In fact, the way it eventually collapsed when the music stopped towards the end of 2015, the right way to do it is probably the way we are doing it in this business now. And new venture, the current venture, which is Benzo, where again we are in a, with a very, very opportune space. We are basically a real money vernacular gaming platform. Gaming, I think, as we all know, has suddenly become a darling of the Indian ecosystem alongside EdTech. So now again, there is a lot of traction, a lot of space is getting heated up. There is folks from all corners of the ecosystem are asking us, why aren't you advertising so aggressively on during IPL? Hey, look at Dream 11, they are capturing the market. Look at MPL, they're doing 10 different things. So at the end of the day, as founders, of course, we've learned our lessons. We know how to pace it out, how to sort of reach our metrics, what we are set out for. A lot more focus on product, a lot more focus on sustainable metrics is there. I think and it really comes with the experience, right? Some of the senior folks on this panel have really shared some beautiful pearls of experience. Which, I mean, one thing is listening to it, but the other thing is only when you burn your own hands, you learn it like nobody's business. So yeah, I think so. Blitz scaling has various aspects to it. I wouldn't say at the end of the day, founders should focus on a very sustainable way to build something and not really go after like only growth. So at the end of the day, I think there is some sense to it. The way your common sense, when there is something that's not meeting the eye, usually given it's a fairly smart group out there. Usually, if things are not meeting the eye, then there must be something that's actually not meeting the eye. So you need to do things which are reasonable and which are digestible to you as a company and to your DNA. I mean, there are certain people who are in general very speed hungry. There are certain people who are discipline hungry, systems hungry. You need to understand what your DNA as a founder is, as a team is, as a leadership is, what kind of partners you partner with on board, be in terms of investors, be in terms of advisors, and according to that, pace it up as per your liking. It's a long journey, right? It's not a one. No market is captured in 1 year or 6 months. I mean, that's all a myth, right? It's a really long journey. I mean, an investor also comes with a 8 to 10 year horizon. I think there was a statistic, that I loosely remember that the typical duration of a marriage in US is, I think, or a startup is, I think, 3 times more than the typical duration of a marriage in US, right? So that's how long you're going to get married to your idea, to your company, to your system. So nobody is taking your business away overnight. You need to you need to build a very, very sustainable journey so that you don't get burnt out. You don't get you don't fall in a pit and avoid mistakes, avoid committing mistakes. I think that's how I would sort of share it. And I can go on and on. There's so many anecdotes on this, but I think then that will be too personal.
Samir, I know you are out of time, but can I just add maybe 30 seconds on this? So, when you asked the question on blitzscaling, I was going to put up my hand saying it's a very bad lesson to teach people. I don't think I have to say anything more because Pawan has more than comprehensively answered that question. So the first investment that I participated in at Greylock was LinkedIn.
Right.
And we have seen how LinkedIn evolved. But I don't know under what frame of mind that book Blitzscaling was written. It was written more by the co-author than Reed. That it teaches so many wrong lessons to people that it's scary. And I also saw the debate in the Greylock boardroom when we invested in Series B in Facebook at 500 million, and people just laughed. The senior partners said, "No way, we are signing up for this." But in hindsight, it looks like crazy. But you can't take the example of Facebook or LinkedIn or Twitter and write a book that this is how entrepreneurship should be done, right? And then some hedge funds, the new hedge funds coming into the country, and some old ones which have been talked about sufficiently on this call. The color of money is same. The color of human beings and their ethos and principles is not the same. So if you team up with somebody whose DNA is not what your DNA is, you are bound to get jagged in life. And there is one of the hedge funds talked about here which left 60 companies orphan in India in 2016. For hedge funds, it's pump and dump because venture is not their business. But entrepreneurs don't understand that. They line up the day they realize somebody is writing a 30 million check for something that doesn't even deserve 3 crores because it's too early, probably right now. So I think I would love to actually, Pawan, take you up on giving this sermon to some folks I know who badly need to hear this. Because I'm probably 10 years older than you, so they'll probably listen to somebody who's closer to their age. Because people really, really need to hear this.
No, absolutely.
Talk about success stories and how much money is being thrown and who is on TV. Nobody talks about how long and hard the journey is to build real companies, right? Because people who make mistakes are shy in our country of talking of mistakes. So we keep hiding them and keep glorifying things which should not be glorified.
Absolutely. Absolutely. Thank you for these perspectives. So all things remaining same, higher growth gets more attention than lower growth, right? So this is where I want to pull in Abhishek. Abhishek, in the past, you backed companies like Manappuram, IKEA, the brick and mortar companies, but they scaled up quite rapidly. When the journey was started, there were multiple competitors. So their superior scale up actually made them stand out from the crowd. So what was their approach to scaling up, which resulted in very good shareholder value creation, alongside the growth itself, and it was a profitable growth.
So I think, first of all, it is very important for a company to be in the right forest. I mean, if you're fundamentally in a market which is going through dislocations, is going through, in our case, most of the things that we are backing are companies which are going through a phase where the industry is moving from unorganized to organized and moving in and making that shift in a meaningful manner. When we invested in Manappuram, I think it coincided with gold loans becoming mainstream. We obviously had to do a lot of work on it because gold loans at one point in time were seen as ostracizing, as something which is usurious, and we had to do a lot of work, including we came up with a marketing campaign, put Akshay Kumar on TV, started the slogan that "Ghar pe padao sona to kahe ko rona Manappuram Finance." We do all those things to break that barrier, but the idea was that our investment in that company coincided with that phase when gold loans became mainstream. From being a sort of side show. Similarly, in case of Quest, it was the time for organized manpower staffing services to become mainstream in India. And there were certain synergies that people were seeing, because of which it made sense for them to put in that extra cost, but get the facilitation that comes with having one partner across multiple locations. So one, I think, is that we were in the right forest. Second is that we backed entrepreneurs who had a vision, who had a vision to do something large, because at times, you end up achieving what you set out to achieve. And when I mean set out to achieve means, with a certain amount of thought and integrity to the process of defining those goals. So, I mean, one is wishing, and the second is setting out to do something. So I think we were very, very lucky. We were very, very fortunate that we backed entrepreneurs who had the vision. They had the good fortune of having some good teams around them. They were in the right forest, And lastly, I think they got very good access to the right kind of capital structure at the right points in time. So I think many of these companies used a combination of internal accruals, used a combination of debt and equity. For example, when you look at Manapuram, equity is only a small part of the capital. A large part of the capital is custom debt. And when we invested, 85% of the book was one single NBFC called Fullerton. It was a 400 crore book. By the time we exited, it was 10,000 crore book with more than 30 lenders, very well diversified, and so on and so forth. So I think these entrepreneurs played the capital structure very well with the right kind of capital at the right points in time. And while we are looking at companies which are so-called brick and mortar, many of these companies have very strong tech enablement inside them. So, which is all over the ambit of operational efficiencies. So one of the things which was very important in all these companies which did very well was how they made operating leverage count. Because if you're a reductionist and if you just break the world into two parts of companies that do well when they scale up and companies which don't, I think the key is how do they play operating leverage. And the good part is all these companies became much more efficient, much more powerful, much more accretive, much more cash generative as they became larger. So you hear about revenues double, losses triple, and then some of those kind of headlines. The good part about these companies were as revenues went going up, there was no losses to begin with, but the profits grew faster. And that to me is the hallmark of a good company. The essence is that you must be doing today things in a better manner than you did yesterday. You should be able to do tomorrow things better than what you're doing today. That's the journey of, people talked about this being a long, hard journey, but the journey has to be fun. And the journey is fun when today is a better day because you learn from what you did yesterday and you add to that. So I think we saw a lot of that learning curve in these companies.
Great. Thank you for these inputs, Abhishek. I will now jump to Ganesh. Ganesh, we are in a VUCA world, volatile, uncertain, complex, and ambiguous. Oftentimes, things don't play out the way you or the founders would have envisaged at the time of investment. Can you share some insights on how better quality companies bounce back from challenges to get on the growth path again?
That's a really loaded question. 2 minutes post closing time. We can go on forever, but see, I think it all starts with starts with kind of the foundational principles of what the founders want to do, and constantly trying to validate that hypothesis. A lot of us fall in love with our ideas, and even the investors and entrepreneurs both. And sometimes we just keep going without sort of bothering to test ourselves, which is very important, especially in the early years. A lot of it really is up to the people, because if it's the right team, if you're right kind of founders, you usually are able to build teams that are better than your competition or the market. And we, for example, we operate in regulated space, so regulations can change. So a lot of VCs, by the way, don't touch regulated space, right? 80% of our companies are in regulated spaces, because there's some financial services angle. So by definition, you are trying to back people, for example, who understand how the system works, who understands how the regulatory context works. They might not agree with it, just like I don't agree with a lot of things in the regulatory context, but you need to first understand it to say, okay, now how do I have that hacker mindset to say, how am I going to play this, right? And then always, which is something I have learned only in the last, I would say, 7-10 years, have a plan B. And I've seen super cautious people who have plan C as well. I mean, there are guys who have plan ABC for funding, the guys who have plan ABC for hiring, guys who will have plan ABC for a partnership with a certain company, whether it's Amazon or Flipkart or Google or whoever. Some entrepreneurs are that good. I mean, frankly, and those are guys I really try to learn from, because some people are really that good in saying plan ABC always, because plan A almost never works. And when the market, like for example, when March happened, like COVID hit, think a lot of people, the first instinct, number of the entrepreneurs and we in our partnership have probably seen at least two big crises before, some mini ones and maybe two big crises. So first instinct of people was, guys, just shut down everything, right? Let's roll back. Really preserve cash. Wherever you are today, preserve cash. But then the smarter guys within 30 days said, I need to test out whether this is a 12, 18, 24-month scenario for me, or I'm actually going to do better. Like one of the companies in our portfolio, Zest Money, is in a space called Buy Now Pay Later, which is exploding around the world. Three of the largest Buy Now Pay Later companies in the world have tripled their valuation, all about $10 billion in market cap today around the world. And the business is growing, just like Zest business is growing. But it took 30 days to say, okay, you know what? It's not going to impact us the same way it impacts everybody. So every business has to say, fine, I rolled back 40% or 50% in cost, but maybe I need to figure out where to start investing even through these times if I think the impact on me will be different. So it's hard to give one silver bullet answer, but the only bullet I'll say is it's really the people and how much they constantly are saying, look, I need backup plans. I need to keep iterating and testing my plans all the time. I can't just sit on glory just because something works today.
Yeah, great, sure. Thank you, Ganesh. While I had a few more, topics for discussion, but I'm told by organizers to, wrap this up. So we'll open the, floor for questions. If people in the audience have any questions for the panel members, feel free to, drop them on the chat window. In the interim, I want to invite Aso Shanglai. He's the founder of C-Marketplace. He's the guy behind this entire, conference. It's his brainchild. I think as part of this, Aso and Sandeep have also, collected data from some of the startups, and they have tried to rate them in terms of their investability score, etc. So maybe he can throw some light on what they have done on that front. So, Aso, over to you.
Thank you, Samir. And thank you for participating, all the panelists. There's so much information and knowledge which has been shared. I actually didn't want to participate in the sense that I didn't want to be a co-host or any of this. I didn't want to take time. I just wanted to listen, but somehow I got sucked in. So some of my attention was diverted, but I'll be transcribing this, and of course, part of it will be available in the website also for people to go through in more detail if they're interested. Now for the investability score, what has happened is that we had discussed this earlier with Ganesh, and Ganesh said, by this kind of task you don't pick up, it will be difficult, it will be time consuming and all. So I realized, of course, this is not my cup of tea. I don't have any understanding of the, the whole startup thing also. So that's where the Sandeep of Hackstrap, he stepped in and he said, okay, let me do this thing. I'm very much interested in this part of the, analysis, and I would want to do it. So it was done quite simply. So there were four T's which were, considered: the team, traction, timing, total addressable market, like that. So based on that, some scoring was given, and part of it that would be, shown to the people who had submitted their decks. So there were around 18 companies which did that, out of which the companies whose score is more than 60, the total score is of course 100. Out of that, those who have achieved more than 60 and all rating, their names and all are will be displayed. Again, please don't take this as something which is like final or something which ends your startup journey and all that. It is just a kind of an outsider view of where your company is based on the deck that you have provided. We have not done any other external research. Anyway, so the top 3 companies are, according to us, in terms of investability. That is, the first company is Sabka Mandi, which is into connecting retailers and company channels. The CEO is, founder is Naveen Prajapati. The second one is Condura Education and Training Services, which is into employability and higher education support. Founder name is Rama Sasank Potturu. And the third one is Golden Pie Technologies, which is a marketplace for bonds and debentures, and the founder is Abhijit Roy. So I just wanted to highlight these companies also in the hope of some of the RVCs and angels who are listening in. These are the good companies, and just wanted to share that and want to give thanks again for participating. Also. Again, time to you, Samir. Yeah, thank you.
No, I think we are good to close the session. I think there was one question which I think Ganesh tried to answer on the chat window. Let's keep the momentum of collaboration, Ashok. I think with that remark, I would like to close the event, unless anyone has anything else to add here. Great. Thank you, everyone.
You again. Bye bye.
Thank you, Samir. Thank you.